G'day and welcome. My name's Peter Bender. I'm from Bundaberg Commercial and I am a commercial realtor and business broker, which means essentially I help people buy and sell businesses and commercial properties. If you're a repeat offender and you've seen my videos before, welcome back and thank you very much for supporting our channel. It's good to know that our numbers are growing, and which means I'm hopefully getting the information that people are asking for. If you're new to the channel, then welcome. What you've stumbled across in your internet search for one of a different cause is a series of videos that I'm making to help people take their investment commercial portfolios and run them as a business. So rather than just having maybe one business and one or two properties, but synergistically putting them together to make the most of the opportunities. Like yourself, I do a lot of research and a lot of study to work out what's available and what we can find. And I've actually made a special edition for this week. What we've done is I had the opportunity to be invited to a video conference, which you'll soon see, which is very special and probably one of the top three that I've seen for the last 12 months. So having a measure of influence, I was able to get permission to tag it onto my channel and let you see the benefits of it. So what you've got firstly will be Lucia, who is head of Seek Business. You may be familiar with Seek Recruitment Services. They also have a growing area which is dealing with online sales of businesses. She's going to go through and explain the trends that she's seen over the last 12 months from a national perspective, which would be quite good. She has a lot of data and a lot of information that I don't have access to, and she's been kind enough to share that with us. The second speaker is Joanna, who is the head of Aspect Legal, which is a specialist commercial legal firm. And she's going to go through the 5 types of vendor finance that are available. Vendor finance is something that's becoming increasingly common, and you really do need to get your head across a little bit of it, both if you're a buyer or a seller. So this is a really good video to go through that aspect. So I would recommend that get yourself a cuppa, and most importantly, get yourself your book of knowledge. For those who are new to the channel, my book of knowledge is where I get you to write down notes, not so much a summary of the presentations that I give, but more so about putting down the key points, and then ask yourself at the end of the video, I'll get yourself a bit of homework each video. This video is look at the 5 types of vendor finance, pick one, and have a think about how you can use that in the future. It's applicable to whether you're a buyer or a seller. And if you can get your head across it, you'll find you get some great opportunities and increase the chances of success that you're looking for. So let me know if you like this video. Please put down a comment and subscribe, those sort of things, because that helps me to get the distribution out to a lot of other people like yourself. So if we can share the journey and let everyone pick it up from there, be much appreciated. Otherwise, I'll see you again next Tuesday when we release the next video in this series, and I hope you enjoy it. Take care and God bless.
Alrighty. Welcome everyone here today. We are so excited to have you here at our webinar today, all about vendor finance, aka deferred payments, talking about security options and negotiation strategies in buying and selling a business. Now, I'll tell you what, the reception to this topic has been astounding. We've had more than 1,000 people sign up for this webinar. So I think we've really hit a nerve here. So very quickly, I'll just quickly introduce myself and Lucia from Seek. So my name is Joanna Oakey, and I am the managing partner of Aspect Legal, which is a multi-award winning commercial legal firm specializing in helping SMEs buy businesses cleverly, grow safely, and exit with maximum impact. And we are super excited to announce that we've just been recently crowned the top boutique legal firm in Australasia. So that's a bit exciting. I'm also the host of the Deal Room podcast, which is a podcast that's been running for more than 5 years with now more than 300 episodes. And in our chat panel here, our team will throw in a little link to that. That's free information. And Dominic, hello. I love it. Why doesn't everyone throw a hello in there? It's just absolutely fabulous to have you all in here. And finally, our book, Buy, Grow, Exit. I'm the author of this best-selling book, Buy, Grow, Exit, that last year was crowned the best small business book of 2023 in the Australian Business Book Award. So that's all very exciting stuff. But today I would like to introduce Lucia Vuong from Seek Business, who joins us as a strategic business leader with more than 15 years experience in product and marketing using technology to solve business problems. Now, Lucia is passionate about helping people live productive and fulfilling working lives as small business owners. And as head of Seek Business, which, if you haven't heard about it, is a marketplace for businesses for sale, she leads a dynamic team whose goal is to make business ownership accessible for all Australians. Lucia, welcome on board to our webinar today.
Thanks so much, Joanna. It's really exciting to be here. As you said, amazing registration rate, really great turnout. Lovely to see everyone saying hi as well. Yeah, I'm really excited to get into this topic today.
Fantastic. Well, look, why don't we kick it off, Lucia, with a bit of and sorry, just very quick check. Someone's just put there, I can't hear you. I'm not sure if that's me or Lucia. No, it looks like someone's helping Richard. Can everyone just put a no if you can't hear any of us? No, you can hear us fine, Jimmy. Thank you for that. Okay, all right. So it sounds like we're working okay here. Thank goodness, Lucia. Lucia, why don't you give us a quick, I guess, launch into this topic by just giving us a bit of an overview of what you are seeing in the market through Seek?
Yeah, definitely. And I won't take up too much time because I know everyone here is here to see and hear about vendor financing and learn about that. And so I'm just going to do a really quick update of what we're seeing. So as Joanna said, we're a marketplace. So we have at any point in time between like 18 to 20,000 businesses on our website for sale. And every month over 150 to 200,000 unique visitors to our website looking for businesses to buy. And so what we do is we take that data and we look at what's happening in the market. What are people looking for? What's selling? All that kind of stuff. And so I'm not going to go into a lot of detail, but essentially we tend to look at the market in the buyer side, how much demand is there for business for sale? And then on the seller side, how much supply is there? How many businesses are there for sale? And on the buyer side, I'm sure everybody, especially in the brokering world, I know there's quite a few brokers out there watching today, will know the demand side has never been better. Like there's never been so many people looking for businesses to buy. Now, the interesting thing about that is that definitely was a trend that came in after COVID. And, you can imagine a lot of people sitting at home thinking, do I really want to be doing my current job the way that I've been working forever? And there's definitely a shift in terms of the types of buyers. There's a lot more corporate or ex-corporate buyers who are looking to either take their skills and experience from being very senior managers in the corporate world to doing their own thing. But there's also a trend of this looking for a different type of lifestyle. And I don't mean lifestyle like people want to sit on the beach and do nothing, but they want to have more control over their time. And being part of the Seek group, one of the things that's really interesting is this trend is across the entire labor market. So this is not just a business buying thing. This is the number one thing that people are looking for in their next career move, whether that's a job or a business, is actually flexibility. So they want more flexibility in their time to choose what they want to spend their time on. So I think one of the lessons from that is not to kind of take away that people don't want to work. It's just they want to choose what they work on. And that's what I love about the small business community is that people actually choosing to take control of their career. And as you said, Joanna, we care a lot about helping people kind of get into fulfilling and productive working lives that they choose. And so that's really exciting. Also on the buyer side, there's some really interesting trends about certain industries that are really rapidly growing. So cleaning as an industry has just skyrocketed. So again, you kind of imagine after 2020, there was some, expected increase in demand, but even today, 3 years later, after lockdowns have ended, cleaning industry is doing, I think it's 69% higher than it was last year if we just looked at the last quarter. And last year it was probably 50% higher than that, like the year before. So it's just constantly growing. It's an amazingly booming industry. And I guess the question to ask there is why is that happening? And it tends to be, demand tends to go where consumer demand is. So if those business industries are growing in the economy, that's where people look to kind of buy into those businesses. On the flip side, there are some industries that are kind of, I wouldn't say declining, but they're slowing in demand. So sport, fitness, adventure, that grew a lot after COVID, but since then has started to kind of normalize a little bit. And so year on year, we actually saw that decline about 4%. And that's probably because it had such a peak as well. So what does that mean for you? If you're a buyer, it means you have a lot of competition. So the best thing you can do is actually stand out. And how do you stand out? The number one way you can stand out is to be ready. So what do I mean by being ready? Do your research, understand how you plan to finance. So attending a webinar like this is perfect. So just getting your head around the space, the process, knowing exactly how you intend to proceed with the purchase, whatever it is, even if you haven't found it yet, if you've got the steps in your head, that is a really good signal when you inquire to sellers that you're serious and you're ready to do this thing, because that is what will help move the conversation forward. So, well done. You're already here. Good start. On the seller side, there's definitely a lot of businesses for sale, more than there were before COVID, but again, also starting to slow a little bit. Now, it is that time of year where that tends to happen, but it is slowing, I think, again, back to that normalization rate, but also the current economy makes selling really difficult. And it's, not too different to the buyer side. Being prepared is the key. So in the current economic environment, sellers want to make sure their businesses look as good as it possibly can to attract the best buyers. So even though there's a lot of competition, you still want to make sure that your business stands out. So that's kind of what's happening in the state of the market. Actually, one more really interesting thing is we saw that there's a bigger trend of high value businesses really growing in demand. So we saw $1 million plus businesses grow by about 24% year on year, just looking at the first quarter of this year to last year. And last year was also growth. So this higher end business is really interesting because what it signals to us is, one, they are more serious buyers, because if you're looking to buy $1 million business, then you're definitely serious about it. But secondly, a lot more businesses looking to buy businesses. So a lot of business owners looking to acquire their second, third business to grow their existing business, which is really exciting trend, really great to see. So yeah, that's what's happening in the market, Joanna.
That's absolutely fantastic, Lucy. So much interesting, insights in that content that you've talked about. I think it's fascinating, some of those areas that you're talking about growth in, and particularly the growth in those high value businesses. And there was this great statistic I saw the other day that said 70% of small businesses are due to change hands in the next 5 years. So what we're seeing at the moment is just the beginning of this cusp. And, there's going to be a lot of activity, and thus it's just super important for buyers and sellers to be across all of these things and, that we're talking about today and will continue to talk about in the future.
Absolutely. Totally agree.
Wonderful. Well, look, thank you, Lucy. And now let's launch into talking about the vendor finance area. So we have had, as I've said, more than 1,000 people register today, and you have asked a heap of questions coming in, which are really insightful. And so we'll be answering these along the way and then opening the floor to questions at the end. This is interactive. If you've got a question, ask it, and we'll try and answer it as quickly as possible. And remember, if you're watching the recording, all the links that we talk about here today will be sent in an email afterwards, and the recording of this will be available for a very short period of time after we run this webinar. Okay, so today we're talking about market trends, what's normal, when to use vendor finance, how to address common concerns, ensuring payment and security. We talk about earnouts versus vendor finance. What does all of that mean? What's the difference? And we'll talk about negotiation and creative approaches. But why don't we kick it off with what on earth is vendor finance? Now, the terminology of vendor finance is a really loose term. Vendor finance is essentially anything where there are payments after a business changes hands. And maybe it's useful for me to explain for people who've come into this webinar what those points in a business sale are. So the first point in a business sale is exchange, and that's where you sign the contract and you exchange it between yourself. Then the next point is completion or settlement. And so both of those words effectively mean the same thing. And at completion, the business changes hands and the buyer pays. But here in a vendor finance scenario, what we're saying is the vendor doesn't pay, the buyer doesn't pay the full amount of the purchase price at completion. They hold back on some of the funds until some point after the business changes hands. Now, another terminology, another word that's used for this is deferred payments. So a payment that is deferred until after completion, that's where that word comes from, or post-completion payments. So payments made after completion. And it's called vendor finance because the vendor is being used to finance the transaction, to enable the buyer to buy the business without fronting up all of the cash at settlement. Now, vendor finance is generally a fixed pre-agreed amount as distinct from payments after settlement that are at risk. Now, I'm going to talk about what that means in just a moment, because that is an opportunity for more creative deal structuring. But there are lots of other types of payments other than just the non-risk payments, so the deferred payments, like earnouts or staggered payments or retentions that can be used to delay payments, but can also be used to deal with risk in the transaction. But basically, so all of these things that we have here in the sheet of what we're talking about today, vendor finance, which is effectively deferred payments or post-completion payments, but also these at-risk payments, which are earnouts or contingency payments. Okay, so let's talk about some trends. We just as a bit of a high level so that you can understand what's going on in the market. So we deal with hundreds of business sale and acquisition transactions each year. So we see a lot of what's happening in the market. And in fact, this was one of the most common questions that was asked on the way in. How common are deferred payments at the moment? The answer is very common. And this is something that surprises buyers and it also surprises sellers. So I think it's really useful to have points like this that are education for the market so people understand what's normal and what's not necessarily normal. Okay, so whilst I say deferred payments are common, they're more common depending on different parts of the market. So now if we break the market into, say, 3 different components, we see varying statistics of how common deferred payments are. So deals less than $1 million in the market, so where the business sale price, somewhere between $1 and $1 million, the use of deferred payments is common, but less than the other ends of the market. So we see this in probably around about 25 to 30% of this market, the less than $1 million market, that have some sort of structuring in the deal. Now, the smaller the deal, so the more towards the $1 than the $1 million, the more the less likely it is to be structured. So the general rule and what we see anecdotally in the market is the higher the sale price, the more likely it is to be structured in some way. So for $1 to $5 million deals, we see around about 60% of the deals fitting into this category being structured in some way. And for $5 million plus, we really see the majority of the deals. So at least 85% of the deals in that $5 million plus range will be structured. So that means there's some component of deferred payment or more likely an earnout. And if you don't know what an earnout is, don't worry, we're about to explain that very soon. So that explains or answers the most common question, but here's some other questions that have been asked. Has this changed? Has it always been common? The answer is I have seen over the last sort of 3 years a massive increase towards smaller deals, having higher and higher level or a greater proportion of smaller deals in that sub $1 million market having vendor finance or deferred payment components in it. So yes, it's getting more common, but more common at the smaller end of the market. At that $5 million plus end, it's still generally what it always was in the market. So that's generally what we're seeing. Another question that was asked is, are there any interests? Are there any costs added? And this is a really important one to understand when you're a buyer coming in. Very interestingly, we see very few of these deals having an interest component added to the top. But usually what sellers want to see is an offer of a higher sales price. So they prefer to see it structured as a higher sales price rather than describing it as interest on the payment. And costs, there's certainly a cost that are involved because there's costs of putting in place the security. So I guess if you liken this to getting a loan from the bank, a bank will put in place various security that might be a mortgage over your property, and there will be costs quite often that might be involved in that, particularly for business financing. Well, the same's the case here in vendor financing. There's a series of documents that might have to be put in place depending on how we're securing the deal, and we'll talk about that in a moment. So that can add a bit of cost in to the deal, but generally not a large amount. And the last question is it controversial and why? And we'll talk quite a bit about this because I think the reality is it can be controversial sometimes with sellers because they don't understand it. They don't understand how it works. They don't understand how to protect themselves. And they don't understand, their advisors don't properly understand it. But it's not actually abnormal. It's actually very normal. So the reality is, as a seller, it's actually a great way to get top price for your business as a seller. But as a seller, you just need to understand and manage the risks. But as a buyer, it's a great way to cash flow a deal without needing all of the funds up front. But on the flip side, you need to understand a seller's potential reservation and be ready to meet them. So that's what today is all about, making sure sellers understand how this works so they're not overly concerned, but they understand what the upside can be for them. And for buyers to understand what the strategy is, how to employ the strategy, but also some of the things that aren't normal in the market that you have to be careful about if you're going to go down this path. Now, we've got a quick poll here. And if you are buying or selling, we're going to launch this poll. Hopefully it's launched there for you. What's the size of your target acquisition or sale price? So if you're selling a business, what's your likely sale price? If you're buying a business, what's the approximate amount that you're looking at paying? And we have got loads of people filling this in. That's fantastic. And we're seeing at the moment, just so that you're seeing, I'll share the results in just a moment. We're seeing around about neck and neck the sub $500,000 market and our $1 to $5 million market. Now, Jimmy can't see the poll. I'm not sure how to make sure you can see it, Jimmy. Our panelists will jump in there and help you see that. But and if you haven't voted, make sure you get in there and vote. But we've had almost everyone vote, which is fantastic. So the end result here is we've got 39% of people who are on the call who have a sale value or looking to buy between 0 to 500K. We have 22% sitting in the 500 to a million. We have 35% sitting in the $1 to $5 million range, and we have 6% in the 5 to 50 million. So there you go. That's just a big insight into the market at the moment, which really does reflect, I guess, where we see buyers and sellers sitting in terms of volume. Okay, so the next most common question that was asked on the way in was, what percentage is normal to be financed? Now, you need to remember from both buy and sell side that the more that is financed and the longer the finance term, the higher the risk for the seller. And so what that means is if the seller has higher risk, it's going to make them more concerned about entering into the transaction, and it's going to make them feel that another deal on the table that doesn't have the same level of risk is a better deal for them to go for. So a really standard number in the market, just so you know, is 80-20. So that's 80% cash up front. Whether that cash is funded from borrowings or not is another question, but 80% payment to the seller and 20% finance either by way of an earnout or by a straight deferred payment. But we also see lots and lots of other different ways of cutting this. And quite recently, actually, I've been seeing a lot more move up to the 40, 50 and 60% finance. But the thing is, the more that you're financing as a proportion of the deal, the more concerned a seller will be. So the more clear you need to be on the security that you're going to offer the seller to help allay their fears that they're not going to get paid. Okay, so what's not normal in the market? Now, I know there's lots of noise in the market about $0 down, and that absolutely can happen. Can I just say it can happen, but it's not the norm. It really isn't the norm at all. It only happens in a very small percent of deals. So this $0 down is a very hard sort of acquisition to find. And the reason for that is if a seller has buyers on the table where they're going to get the money without risk at the time of completion, or get the majority of their money without risk at the time of the completion, they're not going to go for a deal that's highly financed or highly leveraged unless there's a really good reason to do that. Now, I'll give you some reasons in a moment, but I think it's super important to understand $0 down rarely ever happens unless you can find your own way of doing a mix of investor funds, bank funds, or other third-party funding sources, plus vendor finance. And we see that a lot. And that's actually another question that's being asked. Can you run those two types of funding together? The answer is yes, but it needs to be done with a bit of clarity and insight into how you're going to make security work for both of your different types of funders in this situation, the third-party funders and the vendor funding. No security is another not normal or red flag. And no security means that you're not putting anything up to back the finance that's being provided. So we'll talk about the security options in a moment, but just understand that the no dollars down and no security, if that's together, is a huge red flag, and usually only ever happens if there's a business on the market that can't find another buyer that's willing to pay cash and have security. The last thing that's not particularly normal, as I said before, is interest, charging interest, and that's because sellers quite often want the sale to be in a capital payment. But just because there's no interest doesn't mean you can get away with offering vendor finance without having some sort of benefit for the seller. And we'll talk about what those benefits are in a moment. And we've got some great questions here about how to get finance and possible guarantees. And I'm going to talk about guarantees in just a moment, actually. So we will definitely come back and answer those questions soon. All right, so let's address some common concerns. And to be honest, the most common concerns are the concerns that come in from sellers and their advisors. So many sellers and their advisors, if the advisors aren't experienced in business sale and acquisition, initially don't like vendor finance. Why don't they like it, do you think? The reason is because the sellers are handing over the keys to their business vehicle, the keys to their asset, before they're getting full payment for it. And so that to them feels risky. They are worried that they're not going to get paid the full price. They're worried that something is going to go wrong. They're worried that the seller might blow up the business, have no asset left, and they're worried that the buyer is going to blow up the business by not running it well, have no value in the asset left, and then they're going to have no one to recover against. And that really is the general deep-seated fear of sellers in this sort of environment. There are two other fears, but the security for payments is generally, to be honest, the lead fear, and I'll tell you in a moment how we can go about potentially allaying those concerns. But the other issues are or concerns, they don't have access to the capital, so they want to use the money right now, which makes sense, and potentially that they're going to have to pay tax today on something they're not going to receive until tomorrow or some point in the future. So what you need to understand from a buy-side perspective is if you're going to pitch this as a deal structure to your sellers, you need to understand what the benefit is for them, why they would accept this sort of deal. So let's talk about, as a buyer and a seller, how can we understand what that benefit might be for a seller? So I think the reality is, and I said this before, but just not to harp on the point, if a seller can get the same price for the business without agreeing to vendor finance, then that's obviously a better deal for them, right? That makes sense. So how do you make a deal better, even if it's a structured deal, even if it's a vendor finance related deal? So I guess from sell side, we start off with the benefits to a seller of accepting that there might be a deferred component of the payment that they're going to receive for the sale price, i.e. a payment paid after completion, is that they will get access to a larger pool of buyers and potentially a better price. So that's what's in it for you as a seller. If you're open to the concept of vendor finance or deferred payments, including earnouts, you'll have access to a larger pool of buyers and potentially a better price. But here's the rub. You actually may not even be able to sell your business if you don't entertain that as a possibility. So that's always something that's really important to bear in mind, depending on your business, depending on the business value, and depending on how well you've set it up for sale. So from a buyer's perspective, what we always need to be doing is thinking in the mind of the seller. We need to be thinking like them and understand what's important to them in the deal. So it might be important to them to get a higher price in return for getting that price paid later, in which case you might structure the deal in a way that they get a better price. or it might be important to them that they are getting some sort of legacy that is retained in this business. Now, I'll give you a little secret here. Many business owners who have their business on the market have built this business over years and years and years in their life, and they have an emotional connection to the business. They care about their employees and their staff being in the hands of a buyer who's a good buyer, who's a good business owner, who'll care about the staff. They often care about the customers. They often have a close relationship to the customers, and it's often a brand that they've built up over years. So if you can market yourself as being a good buyer, a better buyer, a buyer that's going to do do great things with their business, you can sell and market yourself as a buyer, you have a much higher likelihood of being able to then play with deal terms on the side. And when I talk about deal terms, one of them, of course, is this concept of deferred payments, payments that you can hold back for a period of time until after completion. So as a buyer, you need to understand what's important to the seller so that you can help use that to craft a deal that's attractive to them and then put together an attractive offer. And that might be a better price, but it may not necessarily be a better price. It might be related to you being a better buyer in the seller's eyes than other buyers who are sitting there competing for the business. Okay, so that leads us to security, because this is the key concern of sellers, and often their advisors, if they're not, if they don't deal in this area a lot. How do we make sure the seller is secured? These payments in the future are secured, and we need to start off by looking at what is sufficient security. So we need to ensure as buyers we're making part of the offer some sort of security, and I'll talk about those at the moment, but security that's sufficient depending on how much is financed and the period of payment. So the risk for the seller in the deal increases on the basis of how much is being lent, how long it's being financed for, and the buyer's profile. So they'll be interested in how likely they think it is that the buyer will be able to repay, as well as what the security is that a buyer is willing to offer. Now, there are three sort of main types of security. There are actually a lot of types of security, but I'm just going to cover the three main ones today. And the main ones are guarantees, GSAs, we'll talk about those in a moment, and specific securities. So let's start with guarantees. Guarantees can come in the form of a personal guarantee, a parent company guarantee, or a guarantee from some other personal entity with assets. And effectively, you're saying, well, if the business, this is as a buyer, you're saying if a business can't repay the funds that are owed under the vendor finance deal or the deferred payments, then I personally or my parent company will, or this other entity with assets will will guarantee the payment. So, and I think it's really interesting thinking about guarantees, because what a seller will often say is, well, what does the guarantor have in assets to stand behind the guarantee? However, this is an interesting one. Even if the buyer gives, say, for example, a personal guarantee and they don't have a lot in assets in their own personal names, usually a personal guarantee will still be very valuable to a seller because they have someone else in addition to the business that they can sue for payment of those unpaid funds. So we have guarantees. Then the next we have is security options like general security agreements and specific security agreements. So these are security interests that are registered on the Personal Property Securities Register, the PPSR. Not sure how many of you have heard of the PPSR, but it's effectively a register that records these security interests and gives protection for a seller in this sort of vendor finance situation. So a GSA is a general security agreement, and that's the name for like a mortgage over the business, basically, in really simple terms. So that means a seller will take a mortgage over your whole business, and if you don't pay them back, they have the right to step in and take assets out of the business. But in some instances, a general security agreement won't work because a buyer may need to be able to give financing to other entities. They may need to take out an overdraft. They may need to get financing in other ways. And so in those instances, or it may just be inappropriate, they may only be deferring a very small component of the sale price, and it may just not be appropriate to give a mortgage over the whole business. So in that instance, we turn to specific security agreements. So that means we just take security over select assets. So that might be, we just take security over stock, or give security over stock, or certain equipment, or other certain assets in the business. So that's a way we can narrow, as a buyer, the security that we might be required to give. And as a seller, that's a great way that we can negotiate for getting security, even if a buyer has funding from external sources that means they need to give some security to those other third-party sources too. We also have lots and lots of opportunities for creative approaches here. Oh, and actually, just sorry, one warning. I've got like a little, you'll see a little asterisk here for the general security agreement, which is like the mortgage, and the specific sale agreement. If you're dealing with a share sale versus a business sale, you have to be really careful, because this can trigger something called a whitewash. I'm not going to talk about that because that's far too complex for today, but we will be running a share sale versus business sale webinar in the future next year. So if you're interested about that, please make sure you send our team a note, and we'll make sure we send you an invite when we run that business sale versus share sale. Okay, so that's that. There's loads of other creative approaches involving other components of the business that might have value. For example, maybe the seller will hold back some of the assets and won't transfer them until later, after the final payments have been made. You might connect a breach in payment to things like a lease. There's a heap of other creative things that you can do. And also you can have a look at the way the payments are structured. So for example, some buyers will come in with an offer of a deferred payment that's a lump sum, that's a large amount of money paid at the end of, say, 2 or 3 years. If a seller's really concerned about that, a way to get that across the line is to break that down into regular payments over regular periods. So offering to pay monthly or quarterly over a period of time, rather than there being this big length of time and then this balloon payment. And the benefit of that is that it makes sellers more concerned, because they take risk off the table regularly over time. But it can also be really beneficial to you as a buyer, because it gets you into that good rhythm and easy rhythm of paying out of the profits of the business over time. All right, so what makes a good offer? Essentially, good offer is something where a buyer has understood that they need to sell the idea to the seller. So you have to understand as a buyer that most sellers go to market just wanting full price at settlement. That's their expectation. They don't understand that there's another way. They feel exposed if you suggest another way. Their advisors might also tell them that there's a lot of risk. So there's that issue in the market as well. So you need, as a buyer, to be able to demonstrate the upside for them. And you need to be able to demonstrate why it's not a risk. You need to be prepared to offer security. And if you are going to offer a personal guarantee, just be prepared. They might ask you if you have assets in your own name or funds to meet that guarantee. Sometimes they'll ask, sometimes they won't. But essentially, be careful about making an offer that impacts your ability to otherwise fund the business. And we'll talk about that in a moment. Now, another question that was asked by lots and lots and lots of people on the way in is, what is the difference between earnouts and vendor finance? So there essentially is a big difference in the way the market sees this, because vendor finance is generally viewed as deferred payments that are fixed, where the amounts are fixed. It's not dependent on anything happening in the business after sale. But an alternative type of deal structure is contingent payment arrangement. So that's where the arrangement is set that the amounts paid after settlement or after completion depend on something happening in the business. So here we are. I hope you can all see this. This is a table where we've set out these different options and how they all work. So vendor finance, we have that in the first column. So for vendor finance, we've got, as we said before, a fixed payment that is deferred to a period after settlement. So that means we've agreed on the price. So let's say we've agreed to pay $1 million for the business. We've agreed to pay $600,000 at completion, $400,000 after completion, and we're going to pay that $400,000 in 4 quarterly installments after completion. But we've agreed that what that amount is, it's fixed. There are no triggers. It's not dependent on anything happening post-sale. It doesn't matter how the business performs. It doesn't matter how you perform as a buyer. You make those payments in accordance with the payment schedule you've agreed to. The amount is fixed, and the security options, there's a whole heap of them, but the standard ones are guarantees of some description and a registration on the PPSR. So that general security agreement or mortgage, or a specific security agreement, as I said before. Okay, so the next column here talks about earnouts. And earnouts is what we call a contingent payment. So it is based on something happening in the business after completion. And earnouts, generally the triggers are based on performance. So that's usually EBITDA, that means effectively profit, or revenue, and sometimes other metrics being met. So, for example, what many buyers will do, where they have a business that is really dependent on the owner or the founder as a key person in the business and a key person in the value in the business, is they'll require that the seller stay on with the business for a certain period of time post-completion, that the business meets certain revenue targets after completion, and that forms part of what we call the earnout, or the payment that will be made after settlement or after completion based on the performance of the business, and as long as the seller stays in the business. So the amount that's paid could either be fixed, so you can have an agreement where you say, okay, the earnout is a fixed amount, but you only get that earnout if the revenue in the business is the same for the 12 months after completion as it was in the 12 months before completion. Or it might be variable. In some deals, we'll have deals that say, here's the fixed amount that we'll pay at completion, and then after completion, we'll pay a certain proportion of or percentage of EBITDA or revenue after completion for a particular period of time. And the security options for that are the same as vendor finance, but another additional security that's often put on the table is buyers in that instance might be prepared to put funds in a trust account or a bank account or an escrow account to be held in trust or in escrow for the period of time to secure their own payments. So as you can see, if you're providing funds in trust, it's probably not vendor finance, because at that instance, you're still having to fund, but you're just using the structured component of the deal, so the earnout, as protection of risk. And we'll talk about that later on. So the other types of contingent payment, so contingent means not fixed, it's based on what happens after the sale, are retentions or holdbacks. So retentions or holdbacks here are one payment or multiple payments after settlement. They're based on certain milestones happening. So, for example, if we've got a business where we're not sure if all of the staff are going to transfer with the business, and staff are really critical to the business, we might say we'll pay a certain amount at completion, but then after completion, if 90% of the staff have transferred to us as the buyer, then we'll pay the milestone payment at the end. Or it might relate to clients. So, for example, you might say, if this particular period After completion, the number of suppliers, the number of clients have transitioned that we expect, then we'll make this milestone payment. It's in a way to share the risk with the buyer, between the buyer and seller, of the value in the business transferring. So there are some industries where this is just absolutely standard. As an example, in accounting practice sales, it's really common to have a retention of 10 or 20% of the sale price for 1 or 2 years after completion that is paid out on the basis that the majority of the clients stay with the business. So even in industries, we see some common things happening again and again. Okay, so what are some things to keep in mind? Now, we've had so many questions and I really want to go through and answer them all, but I'll finish this and then we'll see, hopefully we'll have some time to go and answer these questions afterwards. But if you're a seller, so here's a bit of a summary for you. Understand that deferred payments are now a very common part of the business sale market. As I said to you before, that does depend what the sale price is, but even in our sub $1 million deals, we do see deferred payments being a common component. What changes is from our 1 to 5 and our 5 to $10 million deals, we see a lot more of our at-risk deal structuring. So that means a lot more of our earnouts or our milestone or retention holdback payments based on milestones and KPIs being hit in the business. But for that sub $1 million market, there's still a lot of deferred payments around. So remember that a deal is about this matching of price and terms. So the best price in the market might also be connected to terms that you feel have a bit of a risk involved in terms of these deferred payment arrangements. You should ensure your team know how the structure works and that they understand security and that they're not going to freak out if you bring a deal to the table that involves buyers considering using deferred payment strategies. And that's really important because there's no need to freak out. But what you do need to do is get your commercial savvy hat on and say, how can I make this work for me? Does it work for me? And then the next one is consider who pays for the cost of security documentation. So some security doesn't need documentation over and above the sale agreement, but many of these forms of security I've been talking about do need additional security and there can be extra costs. And I generally say this is a great thing for the buyer to be paying because they're the ones who ultimately potentially benefit from this arrangement in the deal. And understand the upside. I think as a seller, make sure you're locked into understanding the upside because there can be an upside for you. Although in some instances, it just might be that you won't be able to find a buyer in the market unless you're open to this type of arrangement. And just remember that the more risk there is in transferring the value in the business, the more requirement there will be to share that risk with a buyer in some way, shape or form. And the very last note for sellers, great idea for sellers, we always think about due diligence being done by buyers on the business that they're buying. But when you're looking at a vendor finance arrangement, we often recommend the flip side, particularly where there's significant payments after completion. Do a little bit of investigation on the buyer, their business history and their ability to pay. Okay, now coming to the summary for the buyers, look at it with sellers' eyes. This is really important. Market yourself to them. Market your ability to pay. Look like a good buyer. The next thing is to work out, make sure you understand, are you risk sharing or are you simply financing? So if the deal you're looking at if the value you're looking to extract out of the business is at risk, So if you think there's some risk of that value transferring, then you may need risk sharing. And we talked about two of those particular ways to share risk. So you might need to think about this so that the seller is incentivized to help ensure that you get the value out of the business in that first year or two, where the business is being bedded down with you as the new owner of it. But if what you're looking for is simply financing the deal, don't overcomplicate it. Make payments fixed, regular and clear. Don't confuse the things. Don't scare buyers off by adding another complexity of making that payment post-completion sound risky to them because they're not sure if they're going to make it or not. So you need to understand if you're approaching this from a risk sharing or a financing perspective. It's okay if you're approaching it from both, but if you are approaching it from both, it might be harder to get across the line with the buyer, with the seller, if you haven't thought about all of these things. Be prepared to offer security. So we've talked about personal guarantees, GSA, but just be careful of a clash of securities if you have other funding arrangements in place. And don't ask for too much. Don't push too far. Don't go crazy with the amount that you try to finance, because the lower proportion the seller gets up front, the more concerned they will be about payment. And the higher the risk, that they'll just go with another buyer who provides better terms. So just bear in mind, you might be able to buy the business for a far lower price, and if you offer full payment at completion and fund it in a different way. So we've just spent the last hour talking about vendor finance, but just remember, it may be easier and cheaper for you to go to a bank, but it may not. So we've got a really quick poll here while I move on to the last slide. Our poll here is, let's launch this one. I don't know which one I'm launching. Oh, wrong one. We'll come back to that in a moment. Oh, I've just lost the poll, so it doesn't matter. Maybe one of our team, can I get our team in the background there to launch a polls for the buyers? What's the primary reason you're considering vendor finance? If we can please have the team share that poll. And I'll move on to our last, while we're having the team share that poll, we're going to move on to our last slide here. We had an overwhelming amount of interest from buyers, and I've been talking to a lot of buyers recently with a heap of common questions and issues. So we're actually putting together a buyers club. We call it the Aspect Buyers Club, which will be based on fortnightly webinars that have how-tos, so how to do due diligence, how to structure a deal, how to make sure you're getting value out of your acquisition. And it will also have deep dives, we'll deep dive into earnouts, how to put together earnouts, how to put together the legal process of an acquisition, and how to do all of these other different things that I've talked about today and haven't even gotten into talking about today. We'll talk about common mistakes. We'll talk about employee entitlements, common mistakes, and common mistakes in acquisitions, and how to avoid them. And we'll also have live workshops for helping put deals together, and so you can see how other people are putting deals together, templates with term sheets, NDAs and more, and live Q&A and hot seats where we help you put these deals together. Okay, for some reason, I've done something terrible with the polls. I really have to apologise. If you're in, here we go, polls are back, good work team. We've also got a buyers community. If you're interested in getting this sort of support, just let us know. We'll send you some information about it. And, you can assess whether or not it's something that is relevant for you to get involved in. So we have our poll here. If you're a buyer wanting support, make sure you've answered that. Oh no, that's gone. Just put a yes. Sorry, we've got some technical issues happening in the background. Just put a yes if you're interested and we'll send you some information. So just say yes. Okay, so we're finished up now. We're close to the end, but we'll stay around for 5 minutes more and answer some questions. If you have some questions that you'd like to get answered. But before I do, handing over to you, Lucia, just to give a last little discussion about Seek Business.
Thanks so much, Joanna. That was amazing. That was really, really informative. And I'm sure everyone thought so. Visit the Seek Business website if you haven't already. But if you have any questions about trends or what's happening in the market, feel free to hit me up on LinkedIn as well. But that's all I'll say, because I think you had it all, Joanna.
Oh, that's too kind. And I'll just really quickly show you a couple of things. Deal Room Podcast, we'll put a link in the notes in a minute to this, and we'll also send you an email with a link, and we will also send you out some emails. We'll send you some emails about Seek Business and how you can get involved in Seek Business as well. If you're interested in the book Buy, Grow, Exit, I have 110 pages all devoted to buying a business, 110 pages devoted to exiting a business. And here's a sneak peek. It's really important to understand how to gear yourself up to exit a business right from the day that you acquire a business. And I also have another 100 pages talking about growing a business. We've got a deal for you, 30% off. So use this coupon. And if you are at the point where you are actually in the middle of a transaction, you're about to sell your business, you're about to buy a business, jump in for this free consultation. All right, we don't have long left, but let's just do a little bit of Q&A and keep feeling free to throw questions in the Q&A. I think we've got loads of questions. In fact, more than 1,000 as you came in. So we've got heaps going on there. Go for it, Lucia. Which one should I answer?
So let's start with one that was asked really early. Are brokers open to vendor financing?
Yeah, so they are, absolutely. And so, it depends on the deal that you're going to offer, because brokers, there's two types of brokers. You have brokers who are buyer's agents, so there's those sorts of brokers around, but brokers who are seller's agents are acting for the seller. Having said that, brokers are this fantastic midway between the deal. There's a way to help make a deal happen, right? But the brokers will be concerned about the same things that sellers are concerned about and sellers' advisors are concerned about, which is like, how do we protect this payment? How do we make sure that we're going to actually, that our seller's going to get the payment at the end of the day, And I think that's a key thing you're going to have to answer for the seller, and you're going to have to answer that same thing for the broker as well.
Yeah, that makes a lot of sense, Joanna. And now to a question that was asked by Lee before the webinar started. What is the difference between vendor financing and financing through banks or loans? And a related question from Arnold, can you have both bank finance and vendor finance on the same deal?
Yeah, great questions, and like really good questions, because these are the real things, that our buyers are grappling with in the market. So the reality is, bank deals depend on what you're providing as security and what you have as security for banks. So, and it's not just banks, but third-party lenders as well, or funders. And generally speaking, as I said, when you're putting together a vendor finance deal, you may not necessarily be offering up interest, but he'll do that if you want. It might be more about a higher sale price or better structured deal. But for banks or third-party funders, it's all about the interest. And that's the thing you need to get your head around. So generally, you can finance a longer deal if you go for a third-party funder. So you can pay back your funding over a much longer period of time. And if you're using your own property to secure it, you can even, get up to the term of the loan over your property. So, we're talking about some significant periods of time that you can fund the deal for if using banks or third-party security, depending on that arrangement. But you might end up paying more, and it might be harder for you to get. And right at the moment in the market, it can take a long time, and it can be hard sometimes to get that third-party funding. So that's essentially where the difference lies. Then to the second part of that question, which is, can you do both in the same deal? 100% you can, but you just need to make sure you're working with advisors who understand how to talk to the funders about this, because what we have to then balance is the security that's being used for each of the different components. So a seller is going to want security, the bank or third party is going to want security. We have to understand how to cut that up and make that work for both of them.
Totally makes sense. And kind of related as well is Sean asked, what's a typical time frame for repayment for a vendor financing deal?
Great question. And that can be how long is a piece of string, but not really actually, because there are some norms in the market. So vendor finance deals where you're looking at a very short period of time, say 3 to 6 months, it will be much easier to get across the line than if you're looking for 3 years, as an example, right? But in sort of like the sub $1 million market, we'll see quite often up to 12 months in funding, in financing. So that's like a really common period in our sort of probably in our sub $2 million market. So up to $2 million, around about 12 months is super common. As we get bigger deals, it becomes more and more common to have longer periods of time. So it might be 1 year, it might be 2 years. And when we're talking about at-risk payments, quite often that will be a 1 or 2 year period. So that's our earnouts or our retention periods. And there are some, when we get into our $5 to $50 million deal segment, getting into 5-year terms does often come into play as well for our earnout. So it depends on the size that you're in, but hopefully that gives you a bit of a guide. And as I say, these are just like rough guides as to what is average in the market. We see lots of deals that sit outside of that. Oh, and actually, just one thing that reminds me, one thing I just want to add, when I said $0 down is not particularly common, and it sort of comes back to this, if you're selling to employees or staff, it actually becomes a lot more common. So that's one thing, and longer payment terms become more common, but there's sort of a relationship there.
Yeah, and that's actually probably also related. It's like you know which questions I'm going to ask next, Jo.
And I actually didn't know.
This one came from Maria today. What normally happens in a family situation for vendor finance? So parents wanting to sell the business to one of their children or their family members. I suspect that's similar to the employee situation as well. Yeah,
absolutely. 100% similar. And that's where we actually sometimes see even more creative deals there. So we might see staggered transitions in that instance. So we might actually see sale in tranches and part sales over time as a way to fund it, so that the exiting family members still get dividends along the way, and the buyers are paying, can actually pay by way of sort of those dividends that they're initially getting. So that's some of the way that we see. And often we might see family retaining some sort of equity in the business. Of course, security becomes less relevant the more people know each other, but family members may still have that concern that they don't have the control over that business once it's in the hand of the buyers. And hey, sometimes buyers want their family members to not be concerned by it, to take a step back. You know what I mean? So loads of different ways to cut that up.
Totally makes sense. So should a vendor be asked whether vendor finance can be applicable in their sale of their business before they go to market?
Yeah, it's a really interesting. That's an interesting question. That sounds like maybe that may have come in from a broker. Not sure where it's going. Well, maybe it's coming in from a buyer saying, "Well, hold on, shouldn't sellers already know this?" Not necessarily, because if sellers can find a deal, and I said this to you before, if sellers can find a deal that's the same deal, but one deal they're going to get 100% cash up front, another deal there's some risk for them in terms of getting paid, they're not getting paid at the beginning, they're going to go for that 100%. So that's why, it's not a given that a seller will have to sell by way of vendor finance. But the reality is, I think this is sort of a message out to, because I know we've got loads of brokers and lots of accountants and other business advisors listening in. This is a message to you. It's warm your sellers up for this reality in the market, because this is a reality. It can be hard sometimes to get the highest price and the best deal without your sellers being open to this. And it's just a call out for them to be working with advisors, accountants, lawyers who accept what is normal in the market and find commercial ways to get to that best outcome. It's about finding the win-win.
Yeah, that makes sense. That totally makes sense. I think we'll do one last question because we are a little bit over time. I don't know which one to pick. So this one's interesting. How common are roll-ups, bringing 2 or more businesses together with a view of for a larger exit?
Yeah, it's really common. So we see a lot of it in the market, both acting for the businesses that are rolling up and acting for the sellers who are selling into a roll up. And there's actually a whole heap of other considerations, sell side and buy side, if you're looking at that sort of structure, because what you're looking at is perhaps a higher risk level and the need to bring this all together in the best way. And in a roll-up, quite often there's different types of roll-ups. Some roll-ups will be really dependent on ensuring key persons stay with the business. And in some roll-ups, that's not as important. But where we do see key persons as being critical, we can see more of a predominance of these earnouts and these at-risk payments coming into play.
Not sure what happened with my lights there. But...
I loved it. No, it's really cool. It's like you're in the nightclub, Lucy. Yeah, I love exactly. It. So cool.
I think it's the room telling me it's time. Oh, thanks so much, Joanna. That was incredible. As I said, really, I learned a lot. Hopefully everyone on the webinar learned a lot as well. There's too many questions to go through, but I'm sure we'll find a way to keep answering those questions.
Fantastic. And look, Lucy, I just want to say a huge thank you to you and Seek Business for being involved. We've really touched a nerve here. We could just see by just the level of registrations, and not just the number of registrations, just all of the questions that you asked on the way in. So I just really want to say thank you to you for all of the attendees who've come into the webinar today. I really, really, really hope you've taken out something that's useful. We'll send you some information afterwards, but just keep in contact. And we're here, from Aspect Legal and Seek Business's perspective, to help serve our business community and help get great deals across the line. So over and out. Lucy, thank you very much for coming along and being involved.
Bye, everyone.
Thanks all. Bye.